I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because
one of your next guests says the markets will find their footing before April 2nd, when the reciprocal tariffs, at least for now, are set to take effect. Joining us now for more is Tom Lee. He is the head of research and founder of Fundstrat, also a CNBC contributor. Also joining us, Nancy Tengler, Laffer Tengler Investments CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high, I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say we're almost 50% pricing in a recession, and we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think two other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the U.S. I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the U.S. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
And that was only, Nancy, nuclear holocaust. I mean, that literally was, we're going to break the world in half with ICBMs. I mean, that was, compared to tariff worries and a slowdown in the economy because we might slap something on European wine or steel, seems very small now. That said, again, and I'm not saying the markets are going to recover next week. I don't know. We're talking about history, and I don't like to bring up politics, Nancy. It always makes me feel like I need a shower, but I will ask you this. How much of this correction that we are seeing do you think, 100%, 50%, 0%, is political, is man-made, is tariff-made?
It's funny you asked that, Brian. It's good to see you. If you look at the consumer sentiment numbers today, and I commend everyone to read Kelly's piece that she wrote this morning, but if you look at behind it by political party, what you see is that Democratic sentiment has not been this low, especially on expectations, ever. And so if you look sentiment overall by party, Democrats down from 91.4 all the way down to 41.4, while independents and Republicans are down somewhat but have held up. And then on expectations, down from 28.2 down from 93.1 to 28.2. So that's driving some of these sentiment numbers that the market's keying off of. And I would just point out that the bond market is not panicking. And so this notion that we're going to go into recession because the Atlanta Fed GDP Now number was revised down, that was driven by imports. They were up 70% in January as purchasing managers trying to get in front of tariffs. So I think just like in 2022, this will all settle in. We are seeing decelerating growth, but that's good for many of the names that have been punished, the reliable earnings growers in technology and consumer discretionary and some financials even. So I think we will continue. This is a correction. We needed one. We get one every 12 months. And so now the question is, have we hit the bottom? Do we have a little more to go? But I don't think we're in a bear market.
GTC event next week. Top chip analyst Stacy Rasgon of Bernstein here with what you should expect from that. It's good to see you. Welcome back.
Good to be here.
As you look ahead to next week, just let's look at what happened to this stock of late. I mean, how should investors feel about it? The ones who love it the most.
Yeah, so I think I heard in your prior segment, if you liked it before, you should love it now. I've been a little, I guess maybe surprised is the wrong word, but I mean, I've been a little surprised at the magnitude of the decline. And I get it. The whole AI space has kind of rolled over somewhat on DeepSeek and macro and tariffs and just a broader degrossing. And I get all that. At the same time, Nvidia, I mean, we're right at the beginning of their Blackwell product cycle. It has just started. It is likely to be the biggest product cycle in their history. We'll likely get some more updates on that next week at GTC. We'll probably also get our first look at Rubin, which is the next generation. We may even get a little look at what comes after Rubin. They may talk about co-packaged optics. They may talk about quantum. They may talk about ARM PCs. They'll probably talk about robotics and every physical AI and everything they talked about at CES. I think it still looks really, really good. And at these current valuations, I mean, it went down to 23 times earnings. It's about 25 now. It's at trough valuations. You've been really, really good buying it there, like historically. I think over the last 10 years, if you bought it at 25 times or below, your average one-year return from that moment was like 150%, and it's never had a negative drawdown over a one-year period buying it under those. I really like it at these valuations in the beginning of a product cycle and with their, their conference of the year starting next week. Yeah.
How do we know? I guess I'd ask it this way. I'm the investor. I love Nvidia. I believe everything that you said. I'm a huge fan of the stock. I agree with you. It's come down. It was never that expensive. Blah blah blah. The whole story, right? That's gotten the stock to where it is. But the DeepSeek thing changed the way that I think I should think about the future, perhaps for this company. Whether it's just going to change the amount of money that needs to be spent, whether it changes the dynamic of the kind of chips that need to be used. And it's just too early to say that it's not going to have a tremendous impact.
But it's already had an impact. But what impact has it had? It's been a positive impact, not a negative impact. This was my read on we talked about this, I think, during that circus.
I know we did, but has it already had that? Just because Satya Nadella and others like you come out and say, well, it's going to lead to more compute, which leads to more chips and blah, blah, blah. I mean.
But what's happened since then? So we've seen H20 like inventory, like in public cloud inventory has gone down. H20 rental prices, I'm sorry, H100, excuse me, inventory has gone down. H100 rental prices have come up. H20, their China sales, like their sales of their China legal parts into China, there's a ton more demand like on the back of DeepSeek. They need more compute, not less compute. All of the hyperscalers and everybody else has been taking their CapEx numbers up by leaps and bounds this year. Again, I think from your prior segment, what I think came out of some of the conferences in this latest season is that those spending plans are still very, very intact. If anything, we've seen increases in demand, not decreases from and since DeepSeek, and that's been my view. But I thought it was positive. Again, the market clearly disagreed, but I think it was good. I think the prevalence of more cost-effective models drives adoption. That's been one of the big barriers to adoption by software companies and the like. It's cost. If we can actually get effective, lower-cost models that drive adoption everywhere, how is that not a good thing? I think it's a good thing.
Are the spending numbers from the hyperscalers recession-proof?
Look, I don't think anything is recession-proof in hardware, like, don't get me wrong. But at the same time, I don't think what they're spending right now is to drive revenue right now. Like, these are long-term investments. They've got, long-term visions. In some sense, it's almost existential, too. So what we have seen is as they're spending on AI, like we've seen like spending on other things like decline. For example, you can look in the traditional server space. And I cover Intel and AMD, and you can look at just like the server CPUs. They've been very bad, like frankly for the last several years, and particularly as AI and spending has shifted toward things like GPUs. Their spend has come out of other areas to focus on AI. I think if they start cutting, and I mean, look, in a recession, I think all bets are off, but this may be like lower down on the list, at least of investments to deprioritize.
I know, but as you talk about, they're spending for the longer term, I feel like we're getting a little less patient to some degree with that. Like we want the results to come sooner at this point. And if you do have a more dramatic economic slowdown, that could throw a wrench into what we thought even, 50 days ago.
Yeah, but that's not unique to AI or Nvidia. That's just a fact, right? Recessions economic uncertainty, tariffs that get put on and taken off like every other day. I mean, that's why the market multiples have come down. Like the earnings, by and large, have not come down nearly as much as any of the stocks have, right? It's all multiple. And why? It's because, in some sense, if things are more uncertain, you don't know what's going to happen, you're going to pay less for that stream of earnings. But that's not like specific to AI. That's a general issue that I think the entire market is facing right now.